Hello and welcome to the Japan Society. I'm Daniel Rosenblum, Director of the Corporate Program, and today I'm talking with Mickey Levy, the Chief Economist of Bank of America. We're talking about the outlook for the U.S. economy. Welcome, Mickey.
Nice to be here.
We have seen the U.S. economy hit bottom, but do you think there are chances we could see a double-dip recession?
No. Although there's a lot of uncertainty out there, my hunch is once the rate of economic growth gets into the positive zone, it'll stay there. Having said that, I think it could end up being a bumpy road to recovery where we have spurts of growth followed by sharp slowdowns. This could be caused by the government stimulus package, how the money flows in, stops and starts in business investment, in consumption. So look for a recovery, not a double dip, but not one of these smooth recoveries.
The latest budget projections from Barack Obama's administration say they expect economic growth to bounce back to 3.2% next year and hit 4.6% by 2012. Is this too optimistic?
It's a stretch. I hope it happens, but when we think about the pace of economic rebound, historically, the sharper our recessions in the U.S., the stronger the bounce backs. And that's certainly a positive, and the monetary and fiscal stimulus by the government is just unprecedented. And those point toward a sharp bounce back, and I think that's what the Obama administration is hoping for. On the other hand, household debt is extraordinarily high. Households need to raise their rates of saving to replenish lost wealth, to pay down debt, and that will constrain spending some. So while I'm not looking for a double dip, and I am looking for a recovery that ends up being healthy and a move back to potential growth, I think the Obama administration is a little too aggressive with that type of projected rebound.
What in your mind is the key ingredient to the U.S. economic rebound?
Okay, absolutely the key here is consumption and the rate of consumer spending growth. Now, in the United States, consumption of services has continued to grow. It's been, the declines have occurred in durable and non-durable goods, autos, household durables, and then discretionary non-durables. The pace of recovery is going to be determined by the bounce back in consumption. Now, in the last year and a half, businesses in the U.S. have slashed inventories. But don't expect businesses to reverse that inventory liquidation until they see a pickup in product demand. So once again, if the pace of the recovery is going to be determined by consumption. The last 3 months, while the economy has stabilized, retail sales have been disappointing, and I'm looking for that pickup. And I expect it'll come, but I think a couple years from now we're going to look back and say consumption rebounded after the sharp decline in the second half of 2008. But the rebound will fall shy of trend line because households need to save, and once again, that's consistent with a bumpy road. But without that consumption growth, businesses aren't going to reinvest, replenish inventory, so that's the key variable.
Well, following the collapse of the housing market, how do you see progress on reaching stability in this very important sector?
I'm actually very pleased, particularly recently. All through 2007, 2008, we had sharp declines in housing prices, yet housing demand, purchases continued to fall, and of course contractors had to cut back on their new housing starts. Just recently, I've seen the sharp declines in housing prices plus the lower mortgage rates, largely as a consequence of the Federal Reserve purchasing mortgages on the open market. I've seen those two factors start to bear fruit in that existing and new home sales have lifted from their recession lows in January, and inventories are starting to come down. So if you consider the sharp declines in home prices and the lower mortgage rates, home affordability's gone up. And what I expect in coming months is further pickups in sales, lower inventories, and the end of just 3.5 terrible years in the housing sector. So we are making progress towards stability.
Even if the recession comes to an end now or even over the next few months, many analysts say unemployment will likely continue to rise as businesses wait to see for sure signs of economic growth before they start hiring. How high do you think the jobless rate could go?
Well, keep in mind, it's increased from about 4.5% to 9.5% already, and implicit in that has been extraordinarily aggressive job cuts by businesses. In fact, much more aggressive than one would have expected given the decline in consumption and, in fact, GDP. So my hunch is most of the bad news is behind us. As businesses have slashed production and employment, inventories are very, very low. Any pickup in product demand, businesses are going to need to stabilize. Now, I think the unemployment rate, which is now 9.4%, drifts up. It may get to 10%, but we're very close to the peak. Now, a key point when we look forward is if you look at past economic recoveries, the job market will exactly mirror the pace of GDP growth. So if we get a healthy rebound in GDP, which of course is contingent on consumption and business responses to consumption, then you're going to get a pickup in aggregate hours worked and employment. The unemployment rate will come down. On the other hand, if it's like the past couple U.S. recoveries that have been quite sluggish in economic rebound, the unemployment rate, it won't go up much higher, but it'll stay up there.
Well, this being the Japan Society, I would be remiss if I did not ask you a Japan-related question. Of course, there's a lot of relevance here. Do you see any parallels between the situation the U.S. economy is in now and Japan's economy in the 1990s? Are there any lessons that we could learn from Japan's experience?
Well, there are parallels, there are dissimilarities, and there are lessons. Some of the parallels, of course, there were bubbles. The central banks came in and tried to halt the bubbles, and then things headed south. In the U.S., banks have been much quicker to acknowledge their problems, to take the write-offs, to raise capital. The government has been much more aggressive than the Japanese government was in the early 1990s. So the adjustment processes, while extraordinarily painful in the U.S., were seemingly getting through it quicker than Japan did in the 1990s. On the negative side for the U.S., there's just the amount of household debt is dramatically higher than anything Japan faced. And so that's a negative for the U.S. Once again, the U.S. Federal Reserve has shifted toward quantitative easing and is much more aggressive than the Bank of Japan ever was. And the key lesson to be learned is, if you remember in the late 1990s, just when consumption was getting ahead of steam in Japan, the government raised taxes, reduced disposable income, and contributed to the economy going back into recession. The lesson to be learned is the U.S. Shouldn't pull the stimulus away and should not raise taxes. And let's just see if we learn those lessons.